Every dollar in this country has a story. Every dollar is held by someone, owed by someone, or sitting in some account waiting. And when you add it all up, the total household wealth of Canada is projected to reach approximately $19.5 trillion in 2026. Take a moment with that number, $19.5 trillion. It is a figure so vast that the human mind cannot truly hold it. If you were to stack that money in $100 bills, the column would reach the moon several times over. And yet, despite this ocean of wealth, most Canadians feel like they are drowning in shallow water. Inflation has slowed. The Bank of Canada has cut its policy rate to 2.25%. Equity markets had their best year in over a decade. By every aggregate measure, the country is richer than it has ever been. So why does the average citizen feel poorer? Why does the math on payday never quite add up? The answer is hidden inside one number, the average. Or rather, two numbers that look almost identical, but tell completely different stories. There are two ways to measure the wealth of a nation, and the gap between them is the gap between the headline and the reality. The first is the mean. The mean is what you get when you take all the wealth in Canada, every dollar, every cent, every cottage and condo and pension fund, and divide it by the number of households. By that calculation, the average Canadian household is worth approximately $1.2 million. $1.2 million. If you are watching this video and your bank account does not match that picture, you are not failing. You are simply learning the first rule of financial statistics. The mean is a lie. It is a lie because of how averages work. When Statistics Canada confirmed at the end of 2025 that the wealthiest 20% of Canadian households averaged $3.5 million per household, while the bottom 40% averaged just $82,000, a single billionaire pulls the entire arithmetic average upward. The mean tells you what the country owns. It does not tell you what you own. The median is different. The median is the middle. If you lined up every Canadian household from poorest to richest, the family standing exactly in the center would have a net worth of approximately $540,000 by 2026. That is the truer picture. That is the household next door. The gap between 1.2 million and 540,000 is the gap between Canada the brochure and Canada the experience. Now we come to the second illusion, and it is perhaps the most uncomfortable. The illusion of the home. Real estate accounts for the majority of non-financial wealth in this country. The principal residence, the place where you sleep, eat, raise children, is also the largest single asset most families will ever own, and it is doing something strange to the numbers. Consider this. Among Canadian families approaching retirement, those aged 55 to 64, who own their home and have a workplace pension, the median net worth is approximately $1.4 million. Those who rent and have no pension, just under $12,000. The same age, the same country, the same economy. A wealth gap of more than 115 times. Now strip out the family home from the median Canadian household. Remove that single asset, and a remarkable thing happens. The median net worth collapses by more than half. Most Canadians, when separated from their walls and their roof, are sitting on perhaps $200,000 of liquid wealth or less, and much of that is locked inside retirement accounts they cannot touch without penalty. This is what economists call asset-rich, cash-poor. You are technically a millionaire on paper, but you cannot eat your kitchen. You cannot pay the gas bill with the equity in your front door. The home is a fortress and a cage at the same time. And Canada has built more of these cages than almost any other country on earth. So with that understanding, let us walk through a Canadian life, decade by decade, beginning at the starting gate. The journey begins with debt. The average Canadian student leaves a 4-year post-secondary program with approximately $28,000 in education debt. Across the country, the total student loan portfolio held by the federal government alone has surpassed $28 billion, and that figure does not include lines of credit, parental loans, or private debt. For a young person aged 18 to 24, The financial reality of 2026 looks like this. An entry-level wage of roughly $20 to $23 per hour. A rental market that consumes between 40 and 60% of after-tax income, depending on the city. A starting net worth that, for most, sits at or below zero. That is not a failure. That is the starting line. The young Canadian under 35 who does manage to climb has a median net worth of approximately $175,000 in 2026, a figure heavily skewed by the small subset who have already entered home ownership, often with significant family assistance. For the renter, with no inheritance, no down payment gift, the median is closer to $50,000 or less. This is not a generation failing to budget. This is a generation running uphill on a treadmill that has been speeding up since the day they were born. Between the ages of 25 and 34, something either breaks open or breaks down. This is the decade where compound interest, career promotions, and partner formation can multiply wealth at remarkable speed. It is also the decade of the great Canadian filter, the housing market. The national average home price is forecast to settle around $689,000 in 2026, with virtually no growth expected in British Columbia, Alberta, or Ontario. But average hides everything. In Greater Vancouver, the average home price is approximately $1.2 million. In Toronto, the average detached home remains well above the $1 million mark. In Saskatoon or Regina, that same housing dollar buys nearly twice the square footage. For the household trying to clear the down payment hurdle, the math is brutal. A 20% down payment on the national average requires nearly $140,000 saved. In Vancouver, that figure exceeds $240,000. The Bank of Canada's policy rate sits at 2.25%, which has cooled monthly mortgage costs slightly, but the affordability ratio remains historically punishing. Those who clear the hurdle, who get into a home with a partner and a stable income by their early 30s, often see their net worth jump dramatically as their property's equity grows. Those who do not, watch the gap widen by tens of thousands of dollars per year, every single year. If your 20s were the filter, your late 30s and early 40s are the furnace. The median net worth for a Canadian family in this age bracket is projected at approximately $450,000 in 2026. On paper, that looks like progress. But this is also the age group with the highest debt service ratio in the country. Households aged 35 to 44 carried a debt-to-income ratio of 245.8% at the end of 2025, the highest of any cohort. The reason is simple and exhausting. This is the decade of three simultaneous crises: a mortgage at its largest balance, childcare costs that can rival a second mortgage in major cities, and aging parents who increasingly require time, money, and attention. This is what researchers call the mental load decade. Every dollar entering the household has three claims on it before it has even cleared the bank. Retirement contributions get squeezed, emergency funds get raided. The career hits its first plateau just as the family expenses peak. And yet, this is also the decade where the foundation either holds or it does not. The habits formed here, automatic RRSP contributions, modest TFSA growth, mortgage prepayments where possible, will determine almost everything that comes next. Then, around 45, something quietly miraculous begins to happen. The mortgage balance, once a mountain, becomes a hill. The children become more independent. Income for most professionals reaches its peak earning years. And for the first time in a Canadian working life, compounding interest begins to outpace personal contributions. The median net worth for households in this bracket is projected at approximately $745,000 in 2026. That is the median. Those who entered home ownership early, who have stayed disciplined with retirement accounts, frequently cross over the $1 million threshold during this decade. This is the acceleration. Every dollar invested at 25 becomes roughly $8 by 65. Every dollar invested at 45 only becomes about $2. The math of time, brutal in your 20s, suddenly becomes your closest ally in your 40s. The decisions you made decades ago now begin paying compound returns. Between 55 and 64, the average Canadian household reaches the financial peak of its entire life. Median net worth in this age band is projected at approximately $960,000 in 2026. The combined holdings of registered accounts, the RRSP and TFSA portfolios, plus any workplace pension, plus the now substantially paid-down family home, place this generation in the strongest position they will ever occupy. But the spread within this group is staggering. Those with both homeownership and a workplace pension hold a median net worth approaching $1.5 million. Those with neither hover near $12,000. The retirement pot is not equally distributed, and it never was. The average Canadian RRSP balance for someone in their late 50s sits in the $250,000 to $300,000 range. Not enough, by most retirement planning standards, to fully replace working income. The home, once again, becomes the silent partner in retirement, often through downsizing, reverse mortgages, or simply being passed down to the next generation. And then comes the great pivot. For 65 years, a Canadian household has been in accumulation mode, earning, saving, building. At 65, the gears reverse. The new task is decumulation. The careful, deliberate spending down of everything that took 6 decades to construct. The median net worth for Canadians 65 and older is projected at approximately $815,000 in 2026, slightly lower than the peak years, reflecting the early stages of drawdown. Canada Pension Plan, Old Age Security, and the Guaranteed Income Supplement together provide a base income, but for most Canadians, these government programs replace only about 40% of pre-retirement earnings. The remainder must come from the household itself. From the RRIF, from the home, from the discipline or the luck of the previous half-century. Now zoom out, and the geography of Canadian wealth becomes impossible to ignore. In British Columbia, the median household net worth in 2026 is projected at approximately $850,000. In Ontario, around $735,000. But cross into the prairies, and the median drops to approximately $435,000 in Saskatchewan and just over $500,000 in Alberta. Quebec sits near $410,000, the Atlantic provinces lower still. This is not a story about hard work. The Saskatchewan farmer works no less than the Toronto consultant. The wealth gap is structural, written into the geography of housing markets that doubled and tripled during the rate-cut decades, while prairie wages and prairie real estate moved at a more measured pace. And there is an even harder truth underneath. The wealthiest 20% of Canadian households now hold 65.7% of all household wealth in the country. The bottom 40% hold 3%. 2/3 of the nation's prosperity sits with 1 in 5 families. So what does the average Canadian net worth at every age really tell us? It tells us that wealth in this country is not a number on a birthday card. It is the slow, almost invisible compounding of habits formed decades earlier. It is the down payment that came from a parent or a savings discipline. It is the workplace pension you almost did not enroll in at 23. It is the spare room that became a rental. The side income that funded a TFSA. The year you ate at home instead of out. Every age in this script has a median number, and behind every median number is a household that beat it and a household that missed it. The difference between them is rarely talent and rarely luck. The difference is usually time. The simple, brutal mathematics of starting 1 decade earlier than you thought you had to. You cannot change the cohort you were born into. You cannot rewind the housing market or undo the rate hikes. But the next decade of your life is being written right now, in the choices you make this week, this month, this year. Wealth is not what you have. Wealth is what compounds while you sleep. And in 2026, the gap between Canadians is no longer measured in dollars. It is measured in decades. If you learned something, like this video and hit subscribe. I'll see you in the next one.